Okay, so today we are going to cover monetary policy and fiscal policy. Fiscal policy and monetary policy. Now, monetary policy means the policy by the monetary authority of our country. Monetary authority of our country. By monetary authority of our country. RBI is the monetary authority of our country. RBI is Reserve Bank of India. Reserve Bank of India. So RBI is the regulator of banking sector in our country. It is the regulator of banking sector. Banking sector in our country. And the formation of RBI was on the basis of Hilton-Young Commission. Hilton-Young Commission. On the other hand, fiscal policy means the policy by the government. By the government. So, what is the major difference between these two? Monetary policy. Monetary policy. That is by monetary authority, that means by Reserve Bank of India. Fiscal policy is by the government. Fiscal policy. So, this is by government. Now, generally there are two major components of fiscal policy. Which are these two components? One is taxation, and second component is public expenditure. Public expenditure. Public expenditure. Now, how taxation is going to impact the demand in economy? That means what will happen if government increase or decrease the taxation? So, we are going to understand that. First thing first, what was the formula for aggregate demand? Aggregate demand. So, aggregate demand stands for C plus I plus G plus X minus M. X minus M. What is C? C stands for consumption. Consumption. I stands for investment. I stands for investment. G stands for investment by whom? By private players. G stands for government expenditure. Government expenditure. So, this government expenditure is part of fiscal policy. Fiscal policy. Along with taxation. Along with taxation. X stands for exports, M stands for imports. So, what will happen if the value of G increases? Now, in this case, consider that rest of the factors are more or less same. Nothing has changed. Only the value of G has increased. Only the value of G has increased. Therefore, subsequently, the value of AD will also increase. We are considering rest of the factors as same or constant. So, this is how, because of public expenditure or because of increased government expenditure, the aggregate demand will increase in the economy. So, this is how economy can be revived. Revived means the growth of economy can be increased by increasing demand in the economy. So, again, during COVID there was lockdown, and because of this lockdown there was unemployment, and because of this unemployment, because people were not getting their regular salaries, they reduced their expenditure and therefore demand was lower. Demand was lower. That is why after COVID, the government tried to recover this economy by increasing demand in the economy through increased public expenditure. Increased public expenditure. It should be noted that if public expenditure is increased, PE, that is public expenditure, if it is increased, it will subsequently increase demand. Why so? Because public expenditure, let's consider the example of a, say, road construction. Road construction. So, in order to construct a new road, raw materials will be required. New manpower will be required. Now, this manpower will receive salary. Here there is a demand of raw materials. So, this is how it will subsequently increase the demand in economy. Similarly, considering the opposite scenario of it, if public expenditure is reduced, again it will adversely impact the demand in economy. Second component of fiscal policy was taxation. Taxation means the amount which we have to pay to the government. We are not talking about details, like we are not going to discuss direct and indirect as of now, because our focus is on inflation right now. So, taxation means the amount in simplest term, say consider this as your salary. Salary minus taxation will be equal to disposable amount. That means you will have this money to spend. You cannot spend your entire salary. Why? Because you will have to pay certain taxation. So, after deduction of that tax, the remaining amount can be spent by the individual. So, higher the taxation, lower will be this amount. Let's consider one example. Suppose someone is having a salary of, say, 100 rupees. So, 100 rupees is salary, taxation is, say, 10 rupees. So, the person will have 90 rupees for expenditure. Now, let us consider one more scenario. Salary is again 100 rupees, taxation is, say, 20 rupees. So, in this case, the person will have 80 rupees. That means, if government is going to collect higher amount of taxation, people will have less money in their pockets. If they will have less money, that means demand will be lower. So, consider it as scenario A, this is scenario B. So, demand is in case of scenario B will be lower than the demand in scenario A. Why so? Because people will have less money. Someone with having 80 money in his pocket can purchase or can demand fewer things as comparison to someone who is having 90 rupees in his pocket. So, this is how taxation structure or tax rates will impact the demand in economy and subsequently they will impact the inflation. So, this was part of fiscal policy. So far we have covered fiscal policy, monetary policy. So, fiscal policy will have two subcomponents. By the way, fiscal policy means the policy by the government. Monetary policy means the policy by the monetary authority, that is by RBI, and RBI has been formed on the recommendations of which commission? It is Hilton-Young Commission. Hilton Young Commission. Now, fiscal policy will have two components. One is taxation, another component will be public expenditure. Public expenditure. So, if taxation will increase, that means people will have less money in their pocket because they will have to pay higher amount of taxation. So, demand will be lower. If taxation is reduced, people will have high amount of money in their pocket and therefore demand will increase. Similarly, if public expenditure PE is increased, this will increase demand in economy. If public expenditure is decreased or reduced, this will reduce demand in economy. Now we are going to cover some of the important tools of monetary authority or monetary policy. First thing first, who is the monetary authority? That is RBI. RBI is the regulator of banking sector. What is the main purpose of banks? Banks provide loan to the public and that is how they earn profit. So, suppose there is a bank B1. Now, bank is going to borrow money or some of the money will be depositors' money. So, bank is going to receive money from different sources. Just for the sake of understanding, we are assuming that there are two sources and the average interest rate is say 6%. Again, it is hypothetical example. Now, bank is going to provide this money as a loan to someone, and let's assume that the interest rate is say 9%. So, this difference between 9% and 6%, this will be the margin for bank, this will be the profit margin for bank. Of course, bank will have to deduct its operational cost as well. So, this is the spread. Spread means the difference between borrowing rate and lending rate. What is lending rate in this case? It is 9%. What is borrowing rate? It is 6%. So, the spread will be 3%. This will be 3%. It is not minus, means it is 3%. That is the difference between the interest rate at which they have provided loan and the interest rate at which they have borrowed money. Okay. Now, banks need money, so they get money from RBI. So, banks can receive money from RBI. That is why RBI is also known as banker of the banks. Banker of banks, because it provide banking facility to the banks. Okay, now coming back to the tools of monetary policy. So, first is repo rate. Repo rate means, let's understand it with the help of a diagram. This is say RBI. This is bank. So, if bank need money from RBI, bank need to pay some amount of interest. So, bank is going to receive money from RBI, and in return, bank is going to provide interest to RBI. This rate is known as repo rate. That means the rate at which banks receive money from RBI. it should be noted that this is for short term. Short term. Then what will be reverse repo? Reverse repo. So reverse repo will be the opposite of it. Let's draw a diagram. This is, say, RBI. This is bank. Now, if banks will have surplus money, they can park it with RBI. So banks can have deposit their surplus money with RBI, and RBI is going to provide interest. RBI is going to provide interest to banks for this money. This will be reverse repo. This will be reverse repo. This will be reverse repo. Now these two components, that is repo and reverse repo are part of LAF. That stands for, LAF stands for liquidity adjustment facility. Liquidity adjustment facility. Liquidity adjustment facility. That means, liquidity means the money. So in simplest term, banks can receive money from central bank, that is RBI, under this agreement. What is the name? It is liquidity adjustment facility. Liquidity adjustment facility. Now, once banks have received the maximum limit under this LAF, then there is another tool to receive additional liquidity. For the sake of understanding, let's assume that this is the limit under which banks can receive fund under LAF. Even after this limit, if banks need additional liquidity, so they can receive that with the help of MSF. That is marginal standing facility. Marginal standing facility. So since this is not a normal thing, I mean, under normal circumstances you can receive fund under LAF, but if you have exhausted your limit, or if you have crossed your limit under LAF, then you can receive additional fund under MSF, and for that you will have to pay higher interest rate. MSF stands for marginal standing facility. Marginal means additional. So it is for additional liquidity. Okay. So far we have covered what is repo, what is reverse repo, what is LAF, what is MSF, what is fiscal policy, and what is monetary policy. Now one more thing, that what will be the impact of repo. So either RBI can increase interest rate is increased, or it can be reduced. If repo rate is reduced, that means now banks will have to pay lower amount of interest. Let's consider, say this is 6%, this is say 4%. So in this scenario, banks will have to pay lesser interest. Therefore, banks are willing to receive money under this. So if banks are receiving money under this, that means they are going to provide loan to the public. Just one simple example. Suppose bank received funding at 6%. So obviously the interest rate for borrower, this is the interest rate of loan, that means the loan which bank have provided to some individual or some businessman. So the interest rate will be 6% plus something, right? Let's assume say A. Why 6% plus something? Because at 6% they have received fund from RBI. So of course they are going to charge extra. That is how they are going to earn profit. So that will be 6% plus something. Here in this case it will be 4% plus something. So this scenario will lead to lower interest rate charged by the bank, lower interest rate charged by the bank. Therefore, more number of people will be willing to receive this loan. More people are willing. On the other hand, in this case, interest rate will be quite higher. Therefore, less number of people are willing to borrow money. So if interest rate is increased, that means fewer people or fewer number of loans will be granted because interest rate has increased. In this case, interest rate is lower, that means more number of people will be interested to borrow amount under this facility. So this is how the change in repo rate or reverse repo rate can impact the money supply in the economy. So if money supply has increased, in which case money supply will increase? If repo is lower. That means if interest rate is lower, then money supply will increase, and if money supply will increase, this may lead to higher demand in the economy. If demand is higher, this may lead to inflation in economy. On the other hand, just consider the reverse scenario. If repo is high, money supply will be low, demand will be low, and inflation will be lower. So these were the topics for today. In the next chapter, we are going to cover some topics related to inflation. Thank you.